Vern is standing by in Edmonton. Vern, go ahead, please.
Yes, thank you, Andy and David, for taking my telephone call. My observations is that the Canadian economy is not doing very well at all. So my question to David is simply this. Why should us fellow Canadians invest in our country, Canada? I'll hang up and listen to your call.
Oh, well, that's a good question. I mean, obviously, you're living in a home currency, the Canadian dollar, and so there is some reason to have assets here. Being outside of Canada and getting currency wrong at some point could hurt you. There's lots of great companies in Canada, but let's be clear. The Canadian market is relatively small on a world basis. I think that Canada is very attractive when you're in a commodity cycle, which I don't believe we are. And so we would prefer to be in the U.S. in particular, because we know the economic backdrop is pretty constructive and solid. And then we would look at some other countries around the world. I mean, certainly there are some great companies and positions for the Canadian market, but I think it should be a relatively smaller piece. In our equity portfolios, we're about 25% Canadian stocks, and the rest would be outside of Canada. And in our income portfolios, I think it's probably closer to 40%. But the net of it is there's a lot of great companies outside of Canada that you really can't afford to ignore.
Okay. John is calling from Toronto. John, you've got a great question. Let's hear it in your own words, please.
Okay. Thanks, Andy. I appreciate the job you're doing there.
Oh, thank you.
Yeah, David, I can only tell you as an adult that over time I've been so tired of listening to the fear that everyone has about this quarter-point increase that the Fed is supposedly going to make. And I don't understand why we're not being told why that fear is so extreme. A quarter point sounds like a bunch of kids arguing over a lollipop. It's like, why is it that we're not being told what's behind the fear? Because I honestly am tired month after month after month of saying, oh, they'll do it in September, they'll do it December, they'll do it in 17, maybe 18. What is the fear that we're not being told about? And David, I always appreciate your answers, so I hope you give it the time that it should take. Okay, thanks so much.
Thanks, John.
John, it's an excellent question. It's an excellent question. Okay, so let's start. Emotion comes from somewhere, right? And markets over the last number of years have had lots of volatility. You know, investors starting in 2000 lived through 2001 and 2. They lived through 2007, 8, and 9. They lived through a big correction through 2011 and the European debt crisis. They lived through a couple of 10%ers last year, and all the while through relatively low, below-trend growth. So there has been built a body of pessimism around markets that's been born out of many years. And that's happened lots of times before. Between 1966 and 82, the market made no progress. And by 1982, when you were beginning an 18-year bull market in stocks, people hated the stock market and they were completely fearful. So, you know, we've got to a point where people are afraid of anything that could possibly disrupt or cause a problem. The obvious reason that the central banks are careful about raising rates is that they have felt that the economy and the economic recovery was somewhat fragile and halting. And so people want to make sure they don't choke that off. The thing you have to understand is that by the time the central bank does raise rates at this point, no central banker wants to be blamed for derailing an economic recovery. She is going to be absolutely certain, she's comfortable that this is not going to be a problem. But that being said, when you look at market strategists, okay, right now, these are supposed to be the experts, the market strategists at the sell-side firms. There is almost uniform bearishness or negativity or caution on behalf of market strategists right now. But interestingly, if you went back over the last 30 years and looked at any time there was such a consensus view of conservatism and caution, the market was up 100% of the time over the following 12 months, an average of 27%. So this is a tempest in a teapot. They should get the rate increase done. People are always fearful of the first interest rate increase because they know it's going to lead to more. But there's a reason why there's an adage, 3 steps and a stumble. Typically, it takes more than 3 rate hike in a cycle to cause a problem for the market and actually slow things down. I think that just, you know, much as being like you do, made about nothing.
Okay. Don is calling from Burlington, Ontario. Go ahead, Don.
Good afternoon, gentlemen.
Hi there.
First question I have was, are large caps for big heads? And the second question is that WSP Global, is that another couche-tard, or what do you think of it in general?
Okay, I wasn't sure if we quite followed the first part of the question.
I missed the first question, so I apologize.
Let's stick to WSP.
So one of the things that I think people should be aware of is that over the last few years, all of the stimulus that we've seen has been monetary stimulus. And that's great for asset prices, and it's good for the 1% who happen to have assets. The thing that we have not seen anywhere in the world has been fiscal stimulus. And the fiscal stimulus is what often creates jobs and spending that impacts the broader population. And one of the things that is a hot topic right now is that countries around the world appear to be getting ready for fiscal stimulus after the U.S. election. So I think that it's very possible that you are seeing an improved performance in construction and engineering companies in a run-up to the expectation that you're going to see more spending in this area. So, there's a number of companies that look pretty good here. WSP Global is one of them, looks attractive. But I think that this is an area that's worth a look, because I think that there is going to be some spending both in Europe and in the U.S. and other countries around the world following the U.S. election.
Okay, and they'll need engineers like WSP Global.
That's right.
Okay, here's an email from Alex in Halifax. Wants to know about Facebook. Could I get your guest's outlook as a long-term hold for up to 10 years?
Well, I think that I'll be careful about making the time frame too long.
Okay.
We always look at things and say, would I like to own it today? And then we ask the question every day. But having said that, Facebook is a remarkable company. It has 1.7 billion monthly users. They have other incredible brands like WhatsApp and Instagram. The thing that's amazing about Facebook is that they have all of this information on all of their users. And the reason that you want to own Facebook is that they're targeting specific advertising, digital advertising. To put a point on it, digital advertising last year was 35% of advertising spend. TV was 37%. So digital spend is catching up to TV. And arguably for an advertiser, it's a much better experience. They're getting very targeted exposure to people. So Facebook is only going to get better at monetizing that giant subscriber base. And Google is as well. And I think probably you need to own both of these companies. The ability to reach a massive number of people in a short period of time is something you can't underestimate, and the mobile side of it is also very attractive. So I think it's a great long-term hold. We own the stock. And it's behaving remarkably well. In fact, today it's hitting a new relative strength high versus the market. So it's hanging in remarkably well in a sloppy market. I'd buy the stock here.
Okay, we've got David's past picks right after this. He got hurt on a cruise company, but did just fine on Amazon. That's after the break.